want to talk about an interesting article that made an appearance in ET, and that is with respect to intermediaries in mutual funds. This is something that all of us have had to tackle with. Sometimes mutual funds do not get directly credited into your account every time you make a purchase or an SIP, and hence SEBI has decided to plug this loophole in MF transactions. Now, if you guys have been tracking the news, I'm sure you may have recognized that this effort of the regulator is amongst the fallout of the Karvi affair. That's the reason why, essentially what SEBI has done is come out with this discussion paper that's called Usage of Pool Accounts in Mutual Fund Transactions. Now, the topic may sound very dreary, but it's extremely important for mutual fund unit holders as well. So let's bring on board Mrin Agarwal, the founder, director of Finsafe, to talk about this paper. Hi, Mrin. Thanks so much for joining us on The Money Show. Like I said, it's a rather drab and technical sounding title, Usage of Pool Accounts in Mutual Fund Transactions. This is the draft paper that SEBI has released. But tell us, why is it so important, this whole usage of pool accounts for mutual funds? How does it work, and what does this draft paper say?
Good evening, everybody. Well, I think it's a very important thing that paper that SEBI has come out with. First and foremost, see, there are two ways in which mutual fund transactions happen. If you are using a stockbroker, for example, then the stockbroker collects all the transactions for the day, collects all the money in an escrow account, and then pools this money in the escrow account and then passes it on to the clearing corporation, which then passes it on to the mutual fund. So what happens in this case, and what SEBI is really worried about, is that in this case, when you're pooling all the transactions and giving the funds or remitting the funds, then the visibility or traceability in terms of which investor invested how much is not there. So what SEBI is suggesting is that there needs to be a direct link between the customer and the mutual fund, and basically customer account funds need to be directly debited or credited to their account without this additional step being there in between.
Okay. Now, interestingly, there's also, how do you sort of correlate this to the Karvi case? Because SEBI as well wants to avoid any sort of Karvi situation come down for mutual fund investors. So, is it a common practice as well for these pool accounts to be used in mutual funds? And why? I mean, is there any sort of benefit or advantage?
Well, I mean, if you look at the data, 50%, like if you look at the data of last year's transactions, 50% of transactions actually came in from pooled account and 50% came in from the non-pooled account. Now, I mean, why does this happen? I think this has just been the practice in terms of how stockbrokers have been working. But why does SEBI not want it? Because if you look at the Karvi case, essentially what happened was that whatever were the securities that were there in the pooled account were what were used to sell off, and then that money was basically invested elsewhere. So essentially they want to plug in this loophole that exists where somebody might be able to use the funds for other activities, which is not correct.
There's also a mention made to demat account usage, and even for that matter, some of these new fintech companies that have app-based mutual fund investing, how do they play a role in this entire thing?
Essentially, investors who are transacting through stockbrokers would be investing directly through their demat accounts. Now, even the fintech companies follow the same model, wherein the investors who invest, they pool in the money in an account and then remit it further. So essentially they're following a similar process as what is being followed in case of people who are investing through the demat account.
So then does it, how do these new app-based fintech companies essentially hinder this entire, mutual fund deposit process. I mean, does this, if let's say I go onto an app, and there are plenty of apps available out there, right, to, start an SIP, do an STP, do an SWP, whatever transaction. If I can even literally transfer from my savings account to a liquid fund, using all these apps. So, would you call this as an indirect route, of, dealing in mutual funds? And would you, that does it mean that we are using pooled accounts when you're using these app-based, app-based processes?
Yes, it is a pooled account when you're using the apps. But when you're using certain platforms, like there are certain platforms from the stock exchanges, those are not pooled accounts.
And I'm selecting an app. Should I be then wary about this? Because I don't want something that's happened, with the Carvi investors to happen with me.
I think so. I mean, I think it's better if you can, not if you can deal through a non-pooled way. So, I mean, one of the easiest ways is, of course, just directly investing on the mutual fund company website, or as I mentioned, you could use the exchange platforms that exist. But yes, it is something to be really wary about, given what we saw in the recent Carvi incident.
Well, yeah, I mean, convenience and reluctance to change, maybe some arguments against this, but over the last few years, I think through UPI, through net banking, I suppose we've got one of the most convenient payment systems in the world. So, and also, when you have a pooled account, there's always, when you're handling other people's money, essentially, there's always temptation to misuse it. That's what even the Carvi affair as well threw up, right? Even though it's a long recognized institution, nationally known names, so your fintech app-based names are still new kids on the block. So you must be a bit wary. And the best way to go and buy is essentially log on to the AMC. If you know that you want to buy a particular fund, let's say, for example, the Kotak Blue Chip Fund, just go on to the Kotak AMC website and you can buy in. And since it's going to be a direct fund, you won't even have to pay anything extra. Direct fund will always give you better returns than, something that you've purchased by an intermediary. So that is always a nice and convenient way, to purchase your mutual funds. On that note, let me remind all our viewers as well that our phone lines are open. You can call in on 24990300, or you can also email us on themoneyshow@etnow.tv. I just have one more question, Mrin, before I'll just give some time for those phone calls to accumulate. But Mrin, I have one more question. You mentioned that the safest way to do so, to buy a mutual fund, and I suppose it would be logistically, quite a nightmare to manage so many mutual funds if we do this. But like I mentioned, I like maybe a Kotak large cap fund, and then I like an HDFC mid cap fund, and maybe a Franklin Templeton small cap fund. So firstly, am I to go into each of these AMC websites and make my purchases, or, book my SIP? And, at the end of the day, when I want to know what SIPs do I have, or how many mutual fund units am I holding of each of these funds, how do I get that?
Well, you could always use the MyCams app as well. I mean, of course, there is a small limitation there in terms of that they don't offer all the funds, but you do have the option, as I mentioned, to use the exchange-based funds. You could use MyCams app as well. So I think, these are some of the alternative ways that you can actually transact. And as far as getting a view, I know going to each website is going to be quite cumbersome. Essentially, but also once you've done the investment, if you just want to view your investments and you want to see how they are performing, or you want to get capital gain reports and stuff like that, again, you can get that on MyCam. So I would say that that's a good alternative as well that's available.
Absolutely free of cost, Mrin?
Yes, absolutely free of cost. And another thing that I forgot to mention on as far as investing through the pooled accounts, or especially through stockbrokers, is the fact that if you are actually investing through them, then the asset management company does not take responsibility or the asset management company does not have the liability on credit of units or on payments, right? So that's another thing. That's another reason why this paper has come out, and that's another loophole, or that's another issue that's being trying to be addressed through this particular paper.
Okay, point taken. All right. Well, folks, you need to be a bit careful when you use pooled accounts. Like we saw the Carvey debacle as well, you do not want that to happen to your mutual funds. It could be quite problematic to see your lifetime's savings and investments actually being misused by somebody else. It could be a bit of an effort, but let's hope that the investing community, SEBI, will come out with a way to sort of simplify buying a mutual fund directly from the AMC and then having a consolidated statement. You could use the CAMS website, but it may have some limitations. Okay, now let me just get on with those viewer queries on our Ask the Money Show segment. Let's take on board our very first question. Shankha Sen writes into us saying that I'm investing 20,000 rupees per month in SIPs. He also writes he's 37 years old and he'll increase his SIPs by 10 to 15% every year. He would, request Mrin to essentially check the constituents of his portfolio. He's willing to take a risk to beat the rising inflation, especially after his retirement. That's in March 2043. So he definitely has, almost 25 years. His question is, can he expect 12 to 13% returns from these funds till 2043? Okay, so he's firstly doing a good thing by ensuring he increases his SIP amount by 10 to 15% every year, because your SIP as well should rise in line with your income. And secondly, he's created a 5-fund portfolio. So let's read that out. 4,000 rupees each in 5 funds. Axis Focus 25 multi-cap, another multi-cap fund, Kotak Standard multi-cap, the SBI Small Cap Fund, the Mrin Asset Emerging Blue Chip, and the Mrin Asset Mid-Cap Fund. I don't see any large cap funds. There are only small caps, mid-caps, and multi-caps. And yes, there's one emerging blue chip fund. So yeah, he's got a couple of questions. Mrin, firstly, are these funds suited for his, goal, which is essentially retiring in March 2043, long-term investor, so I don't think it should be a problem over there. And also, secondly, is it reasonable to expect 12 to 13% returns from these funds every year for the next 23 years?
So first and foremost, I think the funds are fine, except that, he's got a higher exposure in multi-cap and multi-cap funds. And I think, given the fact that he has such a long-term time frame, which is about 23 years, I certainly think that he should be increasing his exposure in mid-cap on the additional investments that he's planning to make. Also, another point is that he has both Mrin Asset Blue Chip as well as Mrin Asset Mid-Cap Fund, and there's a 28% overlap in the stocks out there. So he should basically, try to increase the mid-cap exposure is what I feel, and he should be cognizant of the fact that both the funds have got quite a bit of overlap in terms of the same stocks that they hold. So, don't try to increase exposure in both the funds together.
Recommendation coming in from Mrin on your portfolio. We've got Japesh Thakur from New Delhi who's joining us right now on the phone line. Hi Japesh, good evening. What's your query?
Yes, good evening to both of you, and thank you for taking my question. I had a specific question about, debt mutual funds.
Okay.
Now, there is a general belief that if you look at the interest rate cycle in the economy,
yes,
there is a general belief that in a declining interest rate scenario, the medium term and the short term bond funds tend to do much better.
Okay.
And in case the cycle changes, so that in a rising interest rate scenario or regime, it is felt that liquid funds are a very safe avenue. So
okay,
I wanted to understand that how, as small retail investors, how exactly do we react to a situation like this practically? Supposing I have an inkling that, say, come April 2020, the interest rate regime will, the Monetary Policy Committee may decide to up the rates.
yes.
So is it that I straight away take my funds out from a short-term debt fund and put it into liquid fund? I mean, how do we react exactly? I'll be grateful to have a reply from the expert.
All right. Okay.
Thank you.
Well, thank you, Japesh. And yes, it's true. Bond funds, the values of bond funds tend to move as interest rates move, and interest rates move basically when the RBI decides it has to move. Right now, like Japesh mentioned, we are in a sort of low interest rate environment. But again, inflation's coming back, so you never know what the RBI may do to take action against inflation. For now, though, the stance is accommodative, so one would assume that maybe interest rates will stay at these low levels or may go lower. But yeah, Mrin, firstly, would you advise that a retail investor who's, any which way is busy doing his or her own business, his or her own profession, practicing his or her own profession, would it be prudent for them to track, these interest rate movements? Because it also depends on the 10-year yield, which in turn is market related. And, fixed income as a topic itself is sometimes too complicated. And secondly, yes, if there are individuals like Japesh who are well read, who are well aware of how these things work, would you actually advise them to adjust their portfolio, their position in the debt MFs based on their interest rate expectations?
So first and foremost, yes, I know fixed income is not really very easy to understand. And honestly, I do not advise you to keep shifting the portfolio. What you need to do is that firstly, look at investing in a short-term fund. So typically what happens is that in that the longer term funds, which is let's say a medium duration or your long duration funds, would typically react more both ways. So if the interest rates are falling, then their prices would go up much more. But if the interest rates are rising, then their prices also fall much more. And which is why people say that when the interest rates are rising, you need to be in a liquid or an ultra short term fund. But I think there is one fund category of fund, which is the short term funds, where I find the risk adjusted returns and the volatility to be quite reasonable. And these are funds which I think will be able to weather the storm either way. And of course, see, in all the funds, the fund managers are taking calls on what is the duration of bonds that they want to buy, and that's really based on their own interest rate outlook. So as an investor, I don't think that you need to keep getting in and out of these funds or churning your funds. I would just suggest choose short-term funds. Be clear that your holding period is above 3 years, and you really don't need to worry about the rest of it at all.
Okay, Japesh, I hope you've understood what Mrin is trying to say, and her answer was beneficial for you. Okay, we have Dinesh Bhardwaj from New Delhi joining us on the phone line. Hi, Dinesh. Good evening. What's your query?
Yeah, good evening. Thanks for taking my question.
You're most welcome.
Somehow I'm invested in more funds than I should be investing,
Okay.
and I want to reduce my portfolio.
Okay.
Like I am having 4 multi-cap funds.
Okay.
One is SBI Focused Fund.
Mm-hmm.
The other is SBI Multi-Cap Fund. The other is Aditya Birla Sun Life Equity Fund.
Okay.
And Franklin India Focused Fund.
All
So I
right.
want to reduce these 4 to only 2 or maybe 1.
Okay.
Because I already have a large cap fund as well as mid cap funds in my portfolio.
So you have one large cap fund, one mid cap fund, and you have 4 multi caps. Is that right?
That's right. That's right.
Okay. All right. So do you need the money right now? Is there any specific reason why you want to trim it down?
I don't need it at least for next 3-4 years. I've already invested for the last 5 years.
Okay.
So I want to reduce it. I'm on the verge of my retirement.
Okay.
So I want to reduce my folio to a limited just months.
So you just believe you should trim it down a little because there are too many funds according to you.
That's right. That's right.
Okay, so he doesn't need the money right now. He's already been invested in them for the last 5 years. And now, I suppose in the next 3 to 4 years, he'll be retiring and he perhaps will then want to enjoy.
I'm consolidating my folio so that I
Okay.
can use them at the time of my retirement
Sure.
for SWP withdrawals
Sure.
slowly.
Understood. Okay, all right. Well, yeah, during retirement is when he wants to enjoy the fruits of all this investment. So, yeah, Amrin, firstly, does he need to trim down on any of these multi-cap funds? He's got 6 funds in total, 4 multi-caps, 1 large cap, 1 mid-cap. Do you think he needs to do that right now, or should he just wait the course of the next 3 to 4 years off?
Two things. Well, I think having 4 multi-cap funds is really high, and I think what I heard was that he also had some focused funds which are very concentrated in nature. What I would really suggest is maybe you could look at exiting some of the focused funds that you mentioned. Now, when he's talking about creating an SWP, so ideally you would do this with a debt fund and not with an equity fund. And since you mentioned that you have, I think, 4 to 5 years to go for retirement, what I would suggest is that whatever you're taking out, put it out in a debt fund, invest it into a short-term plan so that it has time to grow over the next few years. And also from a tax perspective, it becomes much more tax efficient to start the SWP once you've remained invested for more than 3 years in a debt fund. So that would be my advice.
Okay. Dinesh, I hope this has been able to help you out, and we wish you good luck in your financial planning journey. Let's move on and take on board our next query. Kalyan De writes into us saying, please advise 2 best debt funds for a period of 1 to 1.5 years and 5 to 6 year holding period. Firstly, also an SIP of a working professional, and later a lump sum investment of a pensioner. Okay, so I think it's an SIP for that 1 to 1.5 years for the debt fund, and also the lump sum investment in the 5 to 6 year debt fund. I think that's what I can understand since he's written respectively. Okay, so fair enough. Mrin, how would you recommend Kalyan they go about his investments in debt fund?
So for the 1 to 1.5 year investment, he could look at either ultra short-term funds, or he could look at the low duration funds. And as far as the 5 to 6 year investment is concerned, I would still again recommend short-term funds itself. So there are a lot of funds to choose from. Again, you have funds which are slightly more conservative, and then you have funds which also take some amount of GSEC exposure. He could kind of look at a combination of these, again depending upon what is his risk profile in terms of how conservative he really wants to be.
Okay, so Kalyan, I hope this answer has been able to help you out. Okay, we have Ankit Gupta who's joining us now on the phone line. Hi Ankit, good evening. What's your query?
Yeah, good evening, ma'am.
Good evening.
Yeah, I am a mutual fund investor. I have certain funds in my account.
Okay.
I'm investing currently in UTI Nifty Index Fund.
Okay.
10,000 rupees.
Okay.
And potential equity.
Sorry, could you repeat that, Ankit? After the UTI Nifty Index Fund where you put 10,000, what were the other funds?
Birla Sun Life 2040, 5,000 rupees.
Okay, ABSL, all right.
And
I think we've got Ankit on a bad line. We were able to catch only 2 funds. The UTI Nifty Index 10,000 and the ABSL Frontline Equity where he puts 5,000. Do we still have Ankit on the phone? Okay, unfortunately, we've lost him. Ankit, if he's watching the television right now, I'd request you can email us on themoneyshow@etnow.tv and we can take up your query, in the course of the next few days. Okay, I want to know if we have time to squeeze in. No, unfortunately, we're out of time on this edition of Ask the Money Show. Folks, if we've not been able to take up your question today, don't fret. You can call us tomorrow or day after, 24990300. Or you can always write in an email to us and we promise we will get that answer. Mrin, thank you so much for joining us on this edition.